In this and some of the next videos, we are going to cover what are the key changes in Budget 2016 relating to the direct tax amendments. Now, the first one is that the corporate tax rate has been reduced to 29% for companies who do not have a turnover exceeding 5 crores. And this is applicable to all the companies. In addition to this, under the startup program, there is an optional reduction which has been given to corporate who put up new manufacturing companies which are registered after March 1, 2016 to 25%. Of course, this comes with a lot of conditions, which we are going to see in some of the next videos that you will see. The surcharge has been raised from 12% to 15% for individuals who have income above 1 crore. There is no higher withholding tax if the non-resident does not have a PAN. So until now, what used to happen was that even in case of non-residents who were getting certain specified incomes, if they did not have a PAN in India, they were liable to a higher rate of withholding tax. This is not going to happen now. Of course, the non-resident has to give certain declaration and certain documents which will be specified, but the higher withholding is not going to be there for the non-residents. The relief under Section 87A for small taxpayer is proposed to be increased from 2,000 to Rs 5,000. The much debated and discussed place of effective management (OEM) rules will be applicable from 1/4/2017. There are two schemes which have come in: Income Disclosure Scheme of 2016 and Dispute Resolution Scheme of 2016, which are meant to reduce the disputes or tracking the black money which has not been disclosed by the taxpayers until now. There are capital gains exemptions and income tax exemptions which are proposed to be given to certain startups. Again, the turnover limit for presumptive taxation has been increased to Rs 50 lakh and 2 crores from the existing limit of 25 lakh and 1 crore respectively. There's an amendment whereby the buyback of shares by an Indian company, all of them, not necessarily the ones which were covered under Section 77 of the Companies Act, are going to be covered for buyback distribution tax. One of the changes which have been suggested is that the dividend, if an individual or a firm, another specified person who are covered, receive dividend in excess of Rs 10 lakh, then the excess shall be taxable at 10% in the hands of the recipient. The company declaring dividend continues to pay the DDT, but if the dividend received by these people exceeds 10 lakh, then they also need to pay 10% tax on it. A patent box regime has been proposed. What this means is that until today, the Indian companies used to do a lot of R&D, but the patents were registered outside India. Under this regime, where an Indian company owns a patent and it receives royalty income, then that royalty income is going to be taxed at 10%. Under transfer pricing, the country-by-country reporting has been introduced. The government has chalked out a detailed plan for phasing out the deductions and profit-linked incentives. Right? The presumptive taxation scheme has been introduced for all professionals with the receipts up to Rs 50 lakh. Under this, you can offer 50% of your gross receipts as income, and then basically you'll be covered as a part of this scheme. The government has proposed to pay 8.33% PF for employees for first 3 years for certain specified categories. Right? Again, there's a relief, or there's not a relief actually, a new provision that foreign company income from storage and sale of crude oil in India is going to be exempt from tax. And a deduction under Section 80JJAA is proposed to be extended to all employees who are subject to tax audit in respect of new employment that they offer. Right? We are going to see a lot more about each of these topics in the next set of few videos. Hang on and look out for them.